Hello friends, welcome back to our channel SNK Company. I hope you are doing well. Let us begin today's video with a fresh set of important and practical updates from the world of taxation and corporate laws. These rulings are extremely relevant for taxpayers, professionals, business owners, and anyone who wants to stay ahead with legal clarity. So watch this video till the end because every case we discuss today carries a strong learning point. We start with key developments under the Income Tax Act. In a significant ruling, the Mumbai Tribunal in the case of Veda Real Estate Corporation Private Limited versus the Deputy Commissioner of Income Tax held that additions cannot be made merely on the basis of uncorroborated documents. In this case, the assessing officer made additions under Section 69A, alleging cash investment in land based on seized Excel sheets and statements of two individuals. However, both individuals later retracted their statements before the assessing officer. More importantly, the Excel sheets were not even prepared by the directors of the assessee company, and there was no independent or external evidence to support the allegations. The tribunal clearly held that such loose papers and retracted statements, without corroboration, cannot form the sole basis for additions, and therefore, the additions were rightly deleted. This judgment once again reinforces that suspicion, howsoever strong, cannot replace evidence. Moving to another important decision, the Delhi Tribunal in the case of News Builders and Developers Private Limited versus the Income Tax Officer dealt with an addition under Section 69C. The assessing officer relied on a draft agreement found during a search in the case of a third party, which allegedly showed that the assessee had paid cash of Rs 1.01 crore for purchase of property. The tribunal noted that the draft agreement was undated, unsigned, and had no evidentiary value. On the other hand, the assessee had furnished complete details of payments made through banking channels. In absence of any concrete evidence of cash payment, the tribunal deleted the addition, highlighting that incomplete and unexecuted documents cannot override documented transactions reflected in books of accounts. In another relief-oriented ruling, the Mumbai Tribunal and Income Tax Officer versus Indic Wisdom Private Limited held that where the assessee had furnished all relevant documents to establish identity, creditworthiness, and genuineness of share subscribers, addition under Section 68 in respect of share premium could not survive. The tribunal reiterated that once the primary onus is discharged by the assessee through documentary evidence, the burden shifts to the department, and additions cannot be made on mere assumptions. The Delhi Tribunal, in the case of Ira Sharma versus Deputy Commissioner of Income Tax, dealt with an interesting issue on set-off of capital losses. The tribunal observed that when losses taxable at a higher rate are adjusted against gains taxable at a lower rate, there is no loss to the revenue. Accordingly, the tribunal upheld the assessee's claim of setting off brought forward long-term capital loss and current year's short-term capital loss against long-term capital gains, holding the claim to be fully in accordance with Section 70 of the Act. Another notable ruling came from the Hyderabad Tribunal in the case of Peninti Vivekananda Rao versus Adit. Here, the assessee had offered income from transfer of Bajaj Equity Plus Fund under the head capital gains instead of income from other sources. The tribunal held that since all material facts were fully and truly disclosed in the return of income, mere classification of income under an indirect head did not amount to misrepresentation or suppression of facts. Consequently, penalty under Section 270A(9) was held to be not leviable. This judgment clearly draws a distinction between a bona fide mistake and deliberate concealment. In yet another important ruling, the Delhi Tribunal in Delight Propcon Private Limited versus Assistant Commissioner of Income Tax clarified the scope of Section 50C. The tribunal held that Section 50C applies only to the seller of immovable property and not to the purchaser. Therefore, any addition made in the hands of the purchaser on account of difference between transaction value and circle rate is unsustainable in law and must be deleted. The Chandigarh Tribunal in Joint Commissioner of Income Tax versus Sharmanji Yarns Private Limited delivered a crucial judgment on bogus purchase allegations. The assessee had produced e-way bills, GST returns, and affidavits from suppliers, all of whom were holding valid GST registrations at the time of supply. The tribunal held that subsequent cancellation of GST registration of suppliers cannot invalidate genuine purchases, and therefore disallowance under Section 69C was unjustified. Finally, under the Income Tax Act, the Hyderabad Tribunal in Sudhir Babu Chalasani versus Income Tax Officer held that where the assessee had substantiated purchase and sale of shares through bank payments, contract notes, and stock exchange records, the assessing officer was not justified in treating sale proceeds as unexplained money. The tribunal accepted the assessee as a genuine investor and deleted the addition, emphasizing the importance of documentary trail in capital market transactions. Let us now move to important updates under GST law. The Bombay High Court held that pineapple slices, pineapple tidbits, and fruit cocktail preserved in sugar syrup and sealed in tins cannot be considered as fresh fruits. Accordingly, these products do not fall under the exemption entry and are taxable. This ruling is particularly important for food processing and trading businesses. In another significant judgment, the Delhi High Court held that where a taxpayer had already deposited a 10% pre-deposit for state GST demand arising from ITC availed from a supplier, and the CGST authorities raised an identical demand for the same period and transactions, the department could not insist on a fresh pre-deposit for filing the CGST appeal. This decision brings much-needed relief in cases of parallel proceedings. The Karnataka High Court also provided clarity by holding that utilization of input tax credit from the electronic credit ledger for making mandatory 10% pre-deposit while filing a statutory appeal is permissible. The court relied on applicable circulars and settled judicial precedents, providing certainty to taxpayers on this procedural aspect. We now come to key developments under other corporate laws. Under SFAMA, the New Delhi Authority in Olympus Granites Private Limited versus the Deputy Director, Directorate of Enforcement, Chennai, upheld attachment of properties purchased from proceeds of crime. The ruling noted that illegal granite quarrying and money laundering resulted in wrongful loss to the government exchequer and wrongful gain to the appellants, and therefore confirmation of attachment was justified. Lastly, the NCLT Hyderabad held that where a personal guarantor failed to repay loan amounts despite issuance of a demand notice and could not produce any evidence of repayment, the application filed under Section 95 for initiation of insolvency resolution process against the personal guarantor was rightly admitted. This judgment reinforces the seriousness of personal guarantees in corporate lending. With this, we conclude today's comprehensive update on tax and corporate law developments. If you found this video useful, do like, share, and subscribe to our channel SNK Co for regular and reliable legal updates. This video is purely for educational and informational purposes only and should not be construed as legal or investment advice. Before taking any action, please consult your tax consultant, legal advisor, or a SEBI-registered investment advisor. Thank you for watching, and see you in the next video.